Hello everyone, welcome to today's webinar on trading with Bollinger Bands, Techniques and Insights. My name is Ali Mortazavi and I'm the head of education here at Arante. First, let me thank you all for joining us today. Whether you're a seasoned trader looking to refine your strategies or a newcomer eager to learn the ropes, I believe you will find this session valuable. Bollinger Bands are a versatile and powerful tool in the world of technical analysis developed by John Bollinger in the 1980s. And these bands help traders assess market volatility, identify potential reversals, and make more informed trading decisions. Today, we will delve deep into the practical applications of Bollinger Bands, exploring both fundamental concepts and advanced technique. So before that, let me mention that this webinar is brought to you by Arante. We are an online broker committed to providing top-tier services and building lasting and trusting relationships with our clients and partners. Please note that all content presented in this webinar is for educational purposes only. So the information provided should not be construed as financial advice, recommendations, or any kinds of investment strategies. Here is the important to know that trading CFDs carries a significant level of risk which may not be suitable for all investors. A considerable number of retail investor accounts lose money when trading CFDs, so you should fully understand the risks involved and consider whether you are prepared to accept the high risk of losing your money or not. And today's insights are meant to enhance your understanding of trading strategies, not to direct your trading actions. Before we dive into the detailed topic for today, let's go over the agenda and what we will be learning. First, we'll start with an introduction to Bollinger Bands, including how they are calculated. We'll discuss a simple moving average or SMA and standard deviation, which are the core components of Bollinger Bands. We know that understanding these calculations is crucial as they form the foundation for measuring market volatility. Next, we will explore how to identify important chart patterns using Bollinger Bands. Specifically, we will look at the M pattern, also known as the double top, and the W pattern or double bottom. These patterns are essential for spotting potential trend reversals. Additionally, we will cover the squeeze pattern, which indicates a period of low volatility and prepares us for significant price movements. Then we will move on to analyzing the bulge pattern. This pattern highlights periods of increased volatility and strong price changes. We will also learn how to identify a squeeze where the price moves significantly consolidated. And then we will also discuss how Bollinger Bands can be used to measure market volatility, detect changes in momentum, and determine the overall market direction. These insights are invaluable for making informed trading decisions and managing risk effectively. Finally, we will have a Q&A session where you can ask questions, engage in interactive discussions, and clarify any doubts you might have regarding the topic we're discussing today. And this is an excellent opportunity to solidify your understanding and enhance your trading knowledge and skills. I hope you prepare your questions for the end of this webinar. Throughout this session, we aim to provide you with a comprehensive understanding of how to use Bollinger Bands effectively in your trading strategies. So I hope at the end of this session, you should feel confident in identifying key patterns and using these tools to analyze market volatility and trends. So if there is no question for now, let's proceed with our agenda. Very well. All right, class. Today we're diving into the fascinating world of Bollinger Bands, a technical analysis tool that's essential for any serious trader. Bollinger Bands were developed by John Bollinger back in the early 1980s, as I mentioned. Now, John Bollinger wasn't just any financial analyst, he was a pioneer who who wanted to understand market volatility better and find a reliable way to identify overbought and oversold conditions in the market. So he realized that by using bands based on the standard deviations around a simple moving average, you could achieve this goal. And this is the philosophy behind the Bollinger Bands. In the 1980s, John Bollinger was working hard to develop a better method for analyzing market volatility. He came up with the idea of Bollinger Bands, which combine a simple moving average with volatility bands that are set at standard deviation. And so over time, Bollinger Bands gained significant traction in the financial community. They became a standard tool in technical analysis, widely adopted by traders and analysts alike. This tool helped them identify potential buying and selling opportunities and better understand market volatility. Fast forward to 2001, John Bollinger published a seminal book titled Bollinger on Bollinger Bands. And this book is an in-depth guide on how to use Bollinger Bands effectively, discussing various strategies and applications. It's considered the most read for anyone serious about mastering this effective tool. So after the initial creation of Bollinger Bands, John Bollinger and other analysts continued to refine and expand on the tool. They integrated Bollinger Bands with other indicators and trading strategies to improve accuracy and effectiveness. This ongoing innovation has ensured that Bollinger Bands remain a vital part of technical analysis today. So bands help traders by providing a clear visualization of market volatility as a core concept of Bollinger Bands and conditions, also guiding us to make more informed trading decisions. But how? Let's discover this together. Let's delve into the essential components of Bollinger Bands, a pivotal tool for any technical analyst. Think of Bollinger Bands as your market's heartbeat, giving you vital signs about this condition. Let's say Bollinger Bands are made up of three key parts: the simple moving average, or SMA, the upper band, and the lower band. First off, let's talk about the simple moving average. The SMA is essentially an arithmetic average of the closing prices over the set period, usually 20 periods. Now, why is this important? The SMA serves as the central line of the Bollinger Band. It's the anchor point, the baseline. It tells you the general direction of the market. If you see the SMA trending upward, the market is likely in an uptrend. And if it's trending downward, well, you guessed it, the market is likely in a downtrend. And if it's moving sideways, the market might be consolidating. It's a simple yet powerful indicator that helps traders identify trends. Next, you see here we have the middle band, the SMA as the middle band here. Next, we have the upper band. Now, this band is calculated by taking the SMA and adding two standard deviations of the price. We will get through the detail of the formula later, but let's now stick with the upper band. It acts as a resistance level. Think of it as a ceiling. When prices approach or hit this band, it often suggests that the market is overbought. Imagine it like stretching a rubber band. The further you stretch, the more likely it is to snap back. So when prices touch this upper band, it might be a signal that a pullback or reversal is on the horizon. It's your cue to watch for potential sell signals. And lastly, let's look at the lower band. This band is calculated by taking the SMA and subtracting to a standard deviation of the price. The lower band functions as a support level, acting as a floor for the price. When prices drop to this band, It often indicates that the market is oversold. Picture that same rubber band analogy. As it stretches down, it's like to bounce back up. Okay, so when prices touch this lower band, it might signal a potential buying opportunity as the market could be poised for a rebound. Now, before we explore the application of Bollinger Bands in identifying trend and momentum, let's take a step back and understand how to calculate Bollinger Bands. This foundational knowledge will deepen our comprehension of their behavior and improve our analytical skills. As we see in this slide, calculated Bollinger Bands involving three key steps. Step one, calculating the simple moving average. The first step is to calculate the SMA, okay, which we explained as an arithmetic average of the closing prices over a specified period, which is typically set to 20 periods for Bollinger Bands. And you can see the formula here. SMS is a sigma, or let's say formula means we add up all the closing prices over the chosen period, which is 20 in this case, and then divide by 20. The result is a smoothed line that reflects the general direction of the market, and filtering out short-term fluctuations and highlighting the broader trend. And you can see the detail of the formula here, but I really prefer not to get through all the nuances about this formula because our main concern is the application and use of the Bollinger Bands, but we just want to review the formula here. And let's get to the second step, which the next step is to calculate the standard deviation denoted by the Greek letter sigma. The standard deviation measures the dispersion or variability of the closing prices around the moving average. So you see the formula here where PI is the closing price of each period and N is the number of periods. Verbally, this means we first find the difference between each closing price and the SMA. We then square these differences, sum them all up, and divide by the number of periods, which is 20 in this case. Finally, we take the square root of this value. The standard deviation gives us a sense of how spread out the prices are around the average. A higher standard deviation indicates greater variability in the prices, while a lower standard deviation indicates that the price are closer to the average. And finally, we use the SMA and the standard deviation to calculate the upper and lower bands. The formula are as follows, where K is typically set to 2. This is a multiplier for let's say the standard deviation. So it means the upper band is calculated by adding 2 times the standard deviation to the SMA, and the lower band is calculated by subtracting 2 times the standard deviation from the SMA. The multiplier K is usually set to 2 to capture approximately 95% of the price action within the bands under normal conditions. This is what statistically we know about the Bollinger Bands indicator, that approximately 95% of the price action are within the bands under the normal conditions. That's why when the price exceeds the bands that let's say that takes our attention, okay? So the behavior of the bands expanding and contracting is directly influenced by the standard deviation. When the price volatility increases, the standard deviation widens, leading to the expansion of the Bollinger Bands. This indicates a period of higher market volatility and a stronger momentum. Conversely, when the price volatility decreases, the standard deviation narrows, leading to the contraction of the Bollinger Bands. This signals a period of lower market volatility and weaker momentum. By understanding these calculations and their implications, we can better interpret Bollinger Bands and make informed trading decisions. So observing the expansion and contraction of the bands helps us gauge market volatility and potentially reversal points, providing a quantitative measure of our technical analysis toolkit. So you see, calculating Bollinger Bands involves determining the 20-period SMA, measuring the standard deviation of the closing prices, and using these values to set the upper and lower bands. And this process not only helps us identify the general direction of the market, but also allows us to assess the strength of price movements and volatility. So are there any questions about this calculation or their interpretations? Please don't hesitate to just write it down through the chat box that you have. Okay, very well. So let's move on. Here we will explore the relationship between, let's say, logical trading and Bollinger Bands, focusing on how this technical analysis tool utilizes statistical and mathematical concepts to help us understand market volatility and trends more effectively. Let's go through this. That Bollinger Bands leverage the principles of standard deviation and simple moving averages, okay, to provide valuable insights in market behavior. But here we want to break it down to some key components and their logical applications. First of all, let's talk about the simple moving average. We said that SMA helps traders identify the overall direction of the market. It acts as the middle line in the Bollinger Bands and represents the average price over time. Also, we have the standard deviation that helps traders gauge market volatility. Okay, but when the price approaches the upper Bollinger Band, the market might be in overbought or near to the overbought conditions, suggesting a potential price reversals. Conversely, when the price nears the lower Bollinger Bands, the market might be in some particular conditions in oversold area, indicating a possible price rebound, but it mostly depends on the situation that we are trading that. For example, if the Euro USD pair reaches the upper band and reversal signs appear, a trader might consider this a selling opportunity and as the end of a bullish trend. But it's not the whole story. We are gonna get through the nuances and we see the scenarios that this needs more, let's say, scrutinizing. Okay, so recognizing reversal patterns. M and W patterns near Bollinger Bands can indicate market turning points. These patterns signal significant changes in market trends. These are the topics that we are going to discuss in nuances in this webinar right now. Okay, so for example, the formation of a W pattern near the lower band can indicate an upcoming bullish reversal, suggesting a buying opportunity. And the next one is the analyzing market volatility. The distance between the Bollinger Bands shows the market's volatility. Narrow bands indicate low volatility, while wide bands suggest high volatility. So, for example, narrow bands in the USD-JPY pair might indicate a period of low volatility, suggesting that traders should watch for a potential breakout before entering the market. And also, Bollinger Bands are a very, very helpful toolkit to identify for identifying breakout points. A decisive break above or below the Bollinger Bands can signal the start of a strong trend, often accompanied by increased trading volume. So the logical foundation of trading with Bollinger Bands lies in the use of the SMA and the standard deviation to measure volatility, identify reversal points, and determine overbought and oversold conditions. And this tool helps traders make better trading decisions by analyzing market fluctuations and trends, thereby capitalizing on trading opportunities effectively. But you might wonder how we can identify trends with Bollinger Bands in, let's say, in a closer picture. So let's get into identifying trade directions using Bollinger Bands in more details here. Let's start by discussing how to identify an uptrend. When a stock or an asset is in an uptrend, you will notice that the price consistently touches or exceeds the upper Bollinger Band. This indicates a strong bullish momentum. Additionally, the middle band or SMA often acts as a dynamic support level. For example, you see here we have an uptrend and we see the SMA acts as a dynamic support level. When the price pulls back, it tends to find support around this middle band before continuing higher. Also, you will observe that the distance between the upper and lower bands typically widens during an uptrend, reflecting increasing market volatility in a certain direction. Conversely, in a downtrend, the price action behaves in the opposite manner. Here, the price consistently touches or falls below the lower Bollinger Band, indicating a strong bearish momentum. The middle band now acts as a dynamic resistance level, where the price tends to rebound downward after approaching it. Similar to an uptrend, the bands widen as volatility increases in a certain way. And finally, let's consider a sideways or a ranging market. In this scenario, the price oscillates between the upper and lower bands without a clear directional trend. The bands remain relatively parallel and narrow, reflecting a stable and low volatility. The middle band is, in this case, doesn't act as a strong support or resistance, but rather represents the mean price level around which the market fluctuates. And this can be taken as a signal for uh, only watching the market and to avoid any trade when we see the market is not trending in a particular direction. So this is how Bollinger Bands help us to identify the overall market direction. But we are going to continue with comparing two specific scenarios to enhance our trading decisions. Let's start with scenario one, the uptrend number one, where the Bollinger Bands have a positive slope indicating an overall uptrend. Here, the price frequently crosses a middle band while making higher tops and higher bottoms. This pattern tells us that the market is in an uptrend, but experiences periodic pullbacks or consolidations. The middle band acts as a dynamic support during these pullbacks. For traders, this scenario presents multiple buying opportunities as the price tends to rebound from the middle band, but it might even drop to the uh, lower band and then bounce up. Therefore, traders can look to buy on dips, okay, especially when the price touches or moves near the middle band and starts to rise again. Using additional confirmation signals such as candlestick patterns or volume spikes, for sure can enhance the reliability of these entry points. Now, consider scenario two in the uptrend two, where the price moves only above the middle band, rarely crossing it. This indicates a much stronger and sustained bullish momentum. The middle band in this case serves as a solid support level with the price consistently maintaining above it. For traders, this scenario suggests a stronger, more consistent uptrend with fewer entry points but higher confidence. Okay, so when the price moves closer to the middle band without crossing it, this level often acts as a robust support, providing excellent buying opportunities. And or let's say setting a stop loss order slightly below the middle band can help protect against unexpected trend reversals. Now let's compare these two scenarios to see how Bollinger Bands not only show us the general direction of the market, but also and the volatility of the market, but it also indicates the momentum of the trend as well, to make sure that we are in a mild market or we are in a very aggressive trendy market. Okay, here scenario one we see offers more frequent entry opportunities due to periodic pullbacks. It's suitable for traders who are comfortable with short-term fluctuations within a broader uptrend. The middle band acts as a dynamic support, but mostly the lower band as well, making it a strategic level for buying on dips. And scenario two indicates a stronger, more consistent uptrend, ideal for traders looking to ride a steady bullish wave. The middle band serves as a strong support, providing clear signals for maintaining long positions with higher confidence and fewer entry points. uh, and all of these features can be applied on the uh, other side scenario of the bearish scenario in a downtrend. Okay, but just to save your time, I'm not going to get through that, but if you get the point, it's applicable on all different market conditions, bullish and bearish markets. In conclusion, both scenarios highlight the importance of the Bollinger Bands slope and price action relative to the bands. By understanding these differences, traders can align their strategies with current market conditions, enhancing their decision-making process and increasing their chances of successful trades. Always remember to incorporate other technical indicators and maintain robust risk management practices, such as setting stop loss orders to protect against adverse market movements. But we're going to discuss how to measure trends momentum as the next step using Bollinger Bands, a key aspect of technical analysis that helps us understand the strength and speed of a trend. Firstly, let's define momentum. In the context of financial markets, momentum refers to the strength and speed at which uh, a price trend is moving. So high momentum indicates that prices are moving quickly and strongly in a particular direction, while low momentum suggests a slower, more subdued trend. Bollinger Bands created by John Bollinger are a valuable tool for gauging momentum. The bands consist of a middle band and the two bands with a standard deviation distance from the SMA. Okay, so when the Bollinger Bands widen, it indicates increasing momentum. This happens because the price is moving strongly in one direction, causing the standard deviation to increase. Expanding bands signal that volatility is rising and the trend is gaining strength. So, for instance, in an uptrend, you will see the price frequently touching or even exceeding the upper band. One of the other key indicators that we need to watch is band contraction. When the Bollinger Bands narrow, it suggests decreasing momentum. This occurs as the price movement becomes more subdued, resulting in lower volatility. Contracting bands indicate that the trend is losing strength, and you may see the price staying closer to the middle band without reaching the outer bands. And then We see the price positioning. The location of the price relative to the bands is also crucial. When the price consistently touches or stays near the other bands, it reflects a strong momentum. For example, in a strong uptrend, the price will hover near the upper band, showing sustained buying pressure. In a downtrend, the price will stay near the lower band, indicating persistent selling pressure. To illustrate this concept, look at chart here. You see periods of bands expansion where the price moves strongly in one direction, signaling increasing momentum. Conversely, uh, periods of band contraction reflect decreasing momentum and a possible upcoming consolidation or even reversal for the price. By observing these indicators, traders can gain valuable insights into the strength of a trend and make more informed decisions. That's why understanding whether momentum is increasing or decreasing helps in timing entries and exits, setting appropriate stop loss levels and managing trades more effectively as a consequence of knowing that when to enter the market. Very well. So now that we have a foundational understanding of how Bollinger Bands measure momentum, let's dive into scenario one, increasing momentum. This scenario helps us identify and understand the characteristics of the market, strengthening trends. In this scenario, focus on the expansion of the Bollinger Bands. As we discussed, when the bands widen, it indicates that the volatility is increasing and the trend is gaining strength. So let's break down what this means in practical terms. Okay. Firstly, band expansion occurs when the price moves sharply in one direction, causing the distance between the upper and lower bands to increase. This widening of the bands is a clear signal that the market is experiencing a strong momentum. For example, in an uptrend, you will see the price frequently touching or exceeding the upper Bollinger Band. This behavior suggests robust buying pressure in the bullish market sentiment. To visualize this, imagine a price chart here at the left of my presentation, my slide, where the Bollinger Bands are expanding. You will notice that as the price makes new highs, the upper band is pushed further up, reflecting the increased volatility, and also the lower band is moving in the opposite direction. For example, with this bullish candle here, you see the lower band is somehow just going down to the opposite direction. So all reflect the increased volatility and momentum in the market. Each time the price pulls back slightly, it tends to find support near the middle band or above it before resuming its upward trajectory. So let's say let's take a look at the implication for traders. Let's discuss the strong buying or selling pressure. I would say expanding bands indicate a strong market momentum. In an uptrend, buyers are in control, pushing prices higher. And in a downtrend, sellers dominate, driving prices lower. And larger price movements and higher volatility with increased momentum, traders can expect more significant price movements. This means greater opportunities for profit, but also higher risk due to the increased volatility. Now let's take a look at the trading strategies and the opportunities that this knowledge can provide us. In this scenario, interpositions in the direction of the trends, one of the common strategies that usually traders, especially the position traders, use Bollinger Bands for trading. It's advisable to trade in the direction of the momentum. For instance, if the bands are expanding and the price is consistently touching the upper band, consider entering or adding to long positions. Uh, of course, another strategy is using trailing stops to lock in profits. To manage a risk while capitalizing on the trend, use trailing stop loss orders. These allow you to lock in profits as the price moves in your favor while still giving the trade room to grow. Let's look at the chart to illustrate this scenario. Here, the Bollinger Bands are clearly expanding as the price climbs higher. Notice how the price often touches or exceeds the upper band, significantly signifying strong upward momentum. Each pullback is relatively minor and finds support near the middle band along the trend. Okay, uh, it allows us to identify strategic entry points. So by recognizing and understanding the signs of increasing momentum trade, we can make more informed decisions in our trading, align our strategies with the prevailing market conditions and potentially enhance our trading performance. So when you observe expanding Bollinger Bands, it's a strong indicator of increasing momentum. Now that we've covered increasing momentum with scenario one, let's turn our attention to scenario two, decreasing momentum. Understanding the scenario is crucial as it signals when a trend may be losing strength and helps us prepare for potential changes in the market. In this scenario, we observe the contraction of the Bollinger Bands. As you recall, when the bands narrow, it indicates that the volatility is decreasing and the trend is weakening. So let's explore what this means in practical terms. Firstly, band contraction happens when the price movement becomes more subdued, causing the distance between the upper and lower bands to decrease. This narrowing of the bands suggests that the market is experiencing lower volatility and the trend is losing momentum. For example, if a downtrend, in a downtrend, if the price is no longer frequently touching the lower Bollinger Band, it indicates a reduction in selling pressure. To visualize the picture price chart where the Bollinger Bands are contracting, like here what you see on my slide, you'll notice that the price tends to stay close to the middle band and doesn't reach the outer bands as often. This behavior reflects a slowdown in the trend's intensity and a possible shift towards consolidation or even reversal. Now, let's take a look at the implication for traders, for us. First, a weakening buying or selling pressure. We know that contracting bonds indicate weakening momentum. So in a downtrend, sellers are losing control and the price stabilizes. In an uptrend, buyers are less aggressive and the upward momentum slows. So this is how we can take advantage of knowing this by looking just at the bands. And the second one, or the next one, the smaller price movements and lower volatility that we can expect from the price chart. With decreasing momentum, traders can expect a smaller price swings. This environment offers fewer opportunities for large profits, but also reduces the risk of sharp adverse movements. Okay, now let's see let's get through the trading strategies. Yeah, first, we can consider exiting positions or tightening stops. When you observe band contraction, it's maybe a signal to take profits and exit positions, particularly if the trend shows signs of reversal. Alternatively, tightening stop loss orders can protect your gains while allowing some room for potential continuation. And the next thing that we can do with decreasing momentum situation or when we see the bands narrowing is look for signs of trend reversal or maybe consolidation. In that case, we need to pay attention to additional indicators and patterns that might suggest a reversal or sideways movement. This could include moving averages, converging, uh, or let's say decreased volume or reversal candlestick patterns. Let's examine a chart to illustrate this scenario. Here, the Bollinger Bands are clearly contracting. Let me just bring up my MT4 and find good part like here. You see, yep. This is a situation we have. Notice how the price stays closer to the middle band with fewer touches to the outer bands. This contraction signals decreasing momentum and suggests that the market might be preparing for a consolidation phase or even a trend reversal here. And for example, also here, when we see a stop or somehow a pause during uh, a trend, as you see, for example, here. So you can go along the trend and you can identify a situation that you see the momentum decreased. And the first sign you can strike from the Bollinger Bands that we see a narrowing bands and the price hovering around the middle band. And this is a very good indication of losing momentum in the market. So in conclusion, when you observe contracting Bollinger Bands, it's a strong indicator of decreasing momentum. So we can use this knowledge to consider exiting or tightening positions and be vigilant for signs of trend reversal or consolidation. Even if you look back at the price chart, you might see, okay, after some a period of consolidation around the middle band, we see a reversal in the price. So this is a warning of exiting the prior trend for us like this. But don't worry, we'll get through more nuances uh, specifically shorter. Okay, now we will continue our discussion on one of the most popular uses of Bollinger Bands, identifying reversal patterns, specifically M and W patterns. These patterns are crucial tools for traders signaling potential trend reversals in the market. Let's delve deeper into the M pattern and particularly understand Bollinger's thoughts on the lower top relative to the upper band, which is a very new concept. Okay, let's get through the definition of the M pattern. Let's say the M pattern, also known as a double top, is a reversal pattern that indicates a shift from an upward trend to a downward trend. As information, we see this pattern forms when the price reaches the upper Bollinger Band and pulls back, attempts to reach the upper band again, but fails, forming an M shape on the chart. The failure to reach a new high on the second attempt signals weakening momentum and a potential reversal. The very, very great example of the M pattern is our recent Euro USD chart, I guess, on a daily chart. If I apply, let's say here, yep. What you see here is a very beautiful formation of the M pattern and Bollinger Bands. Let me just uh, add these lines to make it more clear for all of you who might be new to trading. Okay, here you see a very beautiful M pattern here, but to understand the difference between the M pattern, M Bollinger Bands pattern, and the classic double top, let's get through the concept of the lower top relative to the upper band, which is one of the core concepts in trading with Bollinger Bands. When the price makes its first top, as you see here, it usually touches or slightly exceeds the upper Bollinger Band. Yeah, and this indicates a strong upward momentum and suggests that the market is in an overbought condition somehow. On the second attempt, the price fails to reach the upper band and forms a lower top. And this lower top is a critical indicator in Bollinger Bands framework, as it suggests that the bullish momentum is weakening. You see, the first attempt is out of the Bollinger Bands, but the second one is within the bands. So we consider it as the lower, even if it's higher than the previous top. The price level is higher, but regarding the Bollinger Band theory, we consider it the lower relative top. This lower top is a critical indicator in Bollinger's framework, as it suggests that the bullish momentum is weakening. The inability of the price to reach the upper band again shows that buyers are losing their strength and the upward trend is somehow faltering. So this lower top relative to the upper bands is a key signal that the potential reversal is imminent. The market sentiment shifts and sellers begin to overpower buyers, leading to a downward movement in prices. So we see here a price chart where the first stop reaches the upper band, even exceeds it, signaling strong momentum. However, the second top fails to reach this level, creating a lower high relevant to the upper band. And this divergence between the price action and the Bollinger Band is crucial, as it marks the loss of upward momentum. So this pattern resembles the letter M, as you see on the chart here, and often leads to a bearish reversal as sellers take control. Okay, now let's delve deeper into the W pattern, and particularly understand Bollinger's thoughts on the higher bottom relative to the lower band, which is another core concept in trading Bollinger Bands. So let's start with the definition. The W pattern, also known as a double bottom, is a reversal pattern indicating a change from a downward trend to an upward trend. That's clear to all of us, okay? But let's get through the formation. This pattern forms when the price reaches the lower Bollinger Band and rebounds, attempts to reach the lower band again, but fails, forming a W shape on the chart. The failure to reach a new low on the second attempt signals a weakening momentum and a potential reversal. And now we have the with no surprise, we have the Bollinger's concept of the higher bottom relative to the lower band. But let's take a look at the chart to find a proper example for that as well. Again, this is the Euro USD daily chart, and let's get back to the last week, the last year. Yeah, that's the June 2023. When the price makes its first bottom, let me mark it here. For example, it can be 1, and then here, and then we have this second attempt toward the lower band, which is unsuccessful, and then now. So when the price makes its first attempt, it usually touches or slightly dips below, but here it didn't get to the lower band. Okay, we'll find a perfect example. This indicates a strong downward momentum and suggests that the market is in an oversold condition. But the more important part is the second part. On the second attempt, the price fails to reach the lower band and forms a higher bottom. This higher bottom is a critical indicator in Bollinger's framework, as it suggests that the bearish momentum is weakening. The inability of the price to reach the lower band again shows that sellers are losing their strength and the downward trend is faltering. So this higher bottom relative to the lower bands, if you see the distance, if you compare the distance of the first bottom from the lower band and the second bottom from the lower band, you see we can consider the second one the higher than the previous. Of course, the price level for the second bottom is also higher. So this is a very easy case. However, this higher bottom relative to the lower band is a key signal that potential reversal is imminent. The market sentiment shifts and buyers begin to overpower sellers here, leading to an upward movement in prices. So we can imagine a price chart where the first bottom reaches the lower band, signaling a strong downward momentum. However, the second bottom fails to reach this level. Let's get through another instrument to find a nice let's say a live example here together, because at the end of the day the point of learning all of this is to find a way to trade it. Yep. Here we can find a very nice example of this. If I move to the H4 chart and the USD CAD, again you see the first item is somehow at the upper band here, but the second one is lower than the upper band. So it forms a relative M pattern. But the one which can be interesting is this one, which is somehow different than the classic double bottom formation that we know. And you see, first, the thing that is important is where the price closes. Okay, if I zoom in on this, let's say pattern, you see the price closed just below the lower band, and the second attempt was unsuccessful to exceed the bands or even reach the bands. So we can say the second bottom fails to reach this level, creating a higher low relative to the lower band, even when the price is not higher but lower. Okay, so this divergence between the price action and the Bollinger Band is crucial in as it marks the loss of upward momentum in the market. Okay, but there are some advanced insights we need to consider. One of the critical aspects of validating M&W patterns is volume analysis in a stock trading, which we don't have in forex market. Typically, volume should increase during the formation of the pattern, especially during the breakout phase. For the M pattern, look for increasing volume during the decline after the second peak. For the W pattern, rising volume during the ascent after the second trough strengthens the reversal signals. Next, another advanced technique, let's say, is to use oscillators like the relative strength index or RSI or the moving average convergence divergence to identify divergences. For an M pattern, if the price makes a higher high but the oscillator makes a lower high, it indicates a bearish divergence. And for a W pattern, if the price makes a lower low but the oscillator makes a higher low, it indicates a bullish divergence. And these divergences can provide additional confirmation of the reversal. Okay, let's take a look at the chart to find some live examples. Maybe on lower time frames. I'm going to apply the RSI for 14 periods on my chart. to see additional confirmation. For example, here you can find a very beautiful W pattern, while you see we have a failure swing in the RSI, and also this failure swing in RSI is a very strong signal of a reversal. And we can mark here as the neckline, breaking above this neckline when the price is above the middle band, approaching the upper band is the indication of increasing bullish momentum in the market that can lead us to a new upward movement, as you see here. The one thing, if you have an instrument in mind, just write it down so we can get through those as well. So let's take a look at some lower time frames to see how it works on lower time frames, and you will see on the lower time frames also we can find many opportunities using Bollinger Bands. For example, this is the M pattern here. You can see how market made the first top above, or let's say at the upper band, and then the second attempt failed to reach the upper band. This is the M, and look at the RSI. You see again the RSI is coming back from the overbought area, and this is another failure swing. It's a bearish failure swing, RSI indication. So this is some kind of trading opportunities that we can use. Also the bands as the let's say stop loss and take profit levels. We will discuss it in further details next session in our webinar next week about the Bollinger Band strategies. But you can see that you can put your stop loss here at this level, and you can enter after breaking this neckline here, and you can manage maybe for a 1-to-1 risk reward ratio to close your trade. Okay, this is just an example, guys. So let's move forward. The next one is measuring price targets. We often measure the height of the pattern to project potential price targets. For the M pattern, measure the distance from the peaks to the trough and subtract this distance from the breakout point, as you saw on what we did on the chart. And for the W pattern, measure the distance from the trough to the peak, or from the bottom to the top, and at this distance to the breakout point. And this measurement helps in setting realistic profit targets as a one reward ratio, risk ratio. Okay, before we dive into the specific patterns like the squeeze and bulge, let's take a step back and understand how Bollinger Bands can be used to measure market volatility. This foundational concept is crucial for interpreting the more complex patterns we will discuss later. First, defining volatility. Volatility refers to the amount of price change over a given period, and it's a measure of how much the price of an asset fluctuates. High volatility indicates large price changes and is often associated with periods of market uncertainty or strong trends. Also, high volatility can present both opportunities and risk for traders. On the other side, the low volatility indicates small price changes and is typically seen during periods of market consolidations or stability. Low volatility can precede significant market moves, and that's where we are going to capitalize on trading opportunities. Excuse me. And the next one is a distance between bands. The distance between the upper and lower Bollinger Bands directly indicates the market's volatility level. When the bands are wide apart, it signifies high volatility, suggesting that the market is experiencing larger price swings. Okay, and when the bands are close together, it signifies low volatility, indicating that the market is relatively stable with a smaller price movements. And then we can use Bollinger Bands for detecting volatility changes. How we can do that? Using the distance of the bands. For example, the narrow bands can indicate a period of consolidation and suggest that a strong future movement is likely. This is what we refer to as the squeeze pattern, where the market is squeezing and building up energy for a potential breakout. On the other side, wide bands indicate high volatility and can signal potential large price changes. This is known as the bulge pattern, where the market experiences significant price movements and high volatility. Oh, excuse me for my voice. Then let me just finish it up with discussing, let's say, the very important notice. Guys, Bollinger Bands are not just a tool for identifying volatility, but also for understanding the dynamics of price behavior. So, Bollinger emphasizes that the bands themselves are dynamic, adjusting to the market conditions, which makes them a reliable indicator of volatility. Uh, the volatility as a precursor to trend changes. We need to consider that Mr. Bollinger highlights the periods of low volatility or narrow bands often precede large price movements. It's the market tends to alternate between periods of high and low volatility, and this let's say cyclical nature can be a powerful predictor of future price action, and we will see how we can develop a trading strategy based on this concept in our next webinar. Uh, Also, the next step that we can take is combining with other indicators. Bollinger suggests using the bands in conjunction with other indicators like volume, moving averages, and momentum oscillators like RSI or MACD to confirm signals. For instance, a narrowing of the bands combined with decreasing volume can strengthen the expectation of an impending breakout. Okay, and let's say understanding volatility is crucial for risk management. In periods of high volatility, traders might choose to widen their stop loss levels to avoid being stopped out by normal market fluctuations. Conversely, in low volatility periods, tighter stop loss levels might be more appropriate to decrease the level of the risk. Okay, additionally, knowing when volatility is likely to increase can help traders position themselves advantageously before significant price moves, capitalizing on the breakout opportunities identified by patterns like the squeeze that we are going to discuss in this slide. Okay, so far, if you have any question, please write it down to me. Very well, so let's move on to another important concept in Bollinger Bands, the squeeze pattern. This pattern is essential for identifying periods of low volatility that's often precede significant price movement. Let's get through the definition of the squeeze. The squeeze pattern occurs when the Bollinger Bands come close together, indicating a period of low volatility. This contraction in the bands suggests that a significant price movement may be imminent. Essentially, the squeeze acts as a warning for a strong future move. It's a precursor to market action, signaling traders to prepare for potential volatility spikes. Uh, as an indicator, we should mention that how we can identify the squeeze. First, identify narrow bands. Look for periods where the distance between the upper and lower bands is minimal. This narrowing indicates a reduced volatility. Then we need a low volatility. This quiz is characterized by a period of low volatility. Okay, you can often confirm this with other volatility indicators, such as average through range. And then about the preparation for a strong movement. Once the bands start to expand after a squeeze, it typically signals the beginning of a new trend or a breakout. So traders should be ready to act quickly. And here is some advanced insight from John Bollinger. Bollinger emphasizes that the squeeze alone does not predict the direction of the move. It's really important. Instead, it signals the potential for a significant price change. The direction must be confirmed using other technical indicators or price action analysis. The next thing to mention is that to determine the direction of the breakout, Bollinger recommends using volume analysis, momentum indicators such as RSI and MACD, and observing price patterns. For instance, an increase in volume during a breakout can confirm the strength and direction of the move. And also we need to, after identifying a squeeze, we need to monitor the bands for expansion. The first signs of expansion typically signal the beginning of a new trend. And this is where traders need to be vigilant and ready to enter positions in the direction of the breakout. During a squeeze breakout, it's crucial to have a well-defined trading plan. Set your entry point based on the breakout direction and use a stop loss order to manage risk on the opposite side and the opposite top or bottom of the squeeze. So Bollinger also suggests using trailing stop loss to lock in profits as the trend develops. You can see here on my slide on the chart, we have multiple instances where the Bollinger Bands come close together, indicating a squeeze. These periods of tight bands are followed by sharp price movements. And here, please notice how the bands expands after the squeeze, making the start of a significant price, let's say, trends. So when you identify a squeeze, start preparing for potential trades. Use additional indicators to gauge the likely direction of the move. And once the bands begin to expand, confirm the breakout with volume or momentum indicators, and then execute your trade accordingly. Now that we've covered the squeeze pattern, let's move on to another critical concept in Bollinger Bands, the bulge pattern. And this pattern is vital for understanding periods of high volatility and significant price changes in the market. Let's get through the definition of the bulge pattern. The bulge pattern occurs when the Bollinger Bands widen, indicating increased volatility. This expansion into the bands suggests that the significant price change is occurring or is imminent in the market. Essentially, the bulge signals potential strong price changes and alerts trade alerts us to heightened market activity. The increasing distance between the bands signals potential strong price changes. When you see the bands widening, it indicates that the market is experiencing higher volatility and let's say larger price swings. Let's see how to identify the bulge. To identify the bulge, look for periods where the distance between the upper and lower bands is increasing. This widening indicates rising volatility in a strong market movement. And then the bulge pattern is characterized by high volatility or the highest volatility ever possible in the market. So you can confirm this with other volatility indicators somehow, such as the average true range. And after a period of high volatility, the market often undergoes a correction or a change in direction. Traders should be vigilant for signs of trend reversals following a bulge. And then by narrowing the bias, or let's say the converging bands, you will be able to recognize, or let's say identify, the bulge on the chart. Okay, what we should take a note as from this setup, that while the bulge indicates high volatility, it does not predict the direction of the price change. Instead, it highlights the potential for significant price movements. So traders must use additional tools, again, and additional analysis tools to determine the likely direction. Guys, please keep in mind that the Bollinger Bands indicator is mostly designed to identify and measure the volatility and the sentiment of the market on one side. But to confirm a trade, or let's say a trade setup, we really need to use it in conjunction with the other technical tools. So to gauge the direction following a Bollinger, I recommend using trend following indicators like moving averages or momentum indicators such as RSI or MACD, as you saw how we used it for confirming the M and W patterns. And of course, for those who are trading stocks, observing volume patterns can also provide clues about the strength and sustainability of the move. After identifying a bulge, monitor the market for signs of exhaustion or continuation. It's usual a bulge usually happens at the very overbought or oversold condition in the market. For instance, if the price moves significantly in one direction and starts showing signs of exhaustion, such as decreasing volume or divergence in momentum indicators, it might indicate an upcoming reversal or at least an upcoming correction in the price direction. Okay, and during a bulge, it's crucial to have a clear trading plan. Set your entry point based on the direction of the trend. Confirmed by other indicators, and use stop loss orders to manage risk for sure. It's also recommended that we should be cautious about entering trades late into the move, as the volatility might lead to sharp reversals. So it's not a very good idea to enter the market at the bulge in the direction of the current trend. So when you identify bulge on the chart, it's better to wait for the market to correct itself and to find a better, let's say, entry point, mostly near the middle band. Okay. So when you identify bulge, you can be prepared for potential trades and use additional indicators to determine the likely direction of the move. Once the direction is confirmed, execute your trade accordingly, keeping in mind the high volatility and the potential for rapid price changes. Very well, so that's it from my side, guys. Thank you all for joining us. If you have any question, please write it down to me through the chat box. Okay, we have a question here. What is the smallest time frame to which we can apply the Bollinger Band? It's a really good question. Okay, we can tailor the Bollinger Band setting, first of all, to our specific trading strategy and time frame. Short-term traders might prefer shorter periods, such as 10 periods instead of 20 periods, to make the bands more responsive to recent price movements. And long-term traders might opt for a longer periods, such as a 50 periods, to smooth out the bands and focus on the broader trend. For example, if you are a day trader, you might choose a 10 period setting to get more immediate feedback on price action for quick trades. In contrast, a swing trader might use a 50 period setting to filter out short-term noise and focus on larger trends. So the general answer to this question is the Bollinger Band is usable, applicable for all time frames. Okay, but depends on your strategy and your time frame. You can adjust the setting. For example, nevertheless, it's recommended to keep it simple as possible. But here you see, for example, you can change the period of bands, and also you can change the deviation. But you see here, I have the Bollinger Band for Euro USD on 1 minute chart, and it works pretty good. Yeah, you can see we have uh, the nice visualization as a squeeze, and there is a nice let's say period that we can measure the bulge. Let's say in the market, if we want to find the bulge, you can say here is the bulge. We can find the bulge squeeze, and we can find also the patterns like the M pattern alongside with the trend. And of course, we can identify the direction of the trend using the position of the price compared to the bands, and also we can use it properly on any time frame. But the thing is that you can adjust the setting to see which one is more appropriate with your trading strategy. I hope I could answer your question. Okay, let's take a look at the other question. If we have okay, here is a good question. Is it possible to misinterpret a Bollinger Band bulge? Uh, yes, of course, we can misinterpret a bulge as a signal to enter a trade in the direction of the recent trend. This is the most misinterpretation of the bulge that some traders, when they see let's say the accelerated momentum in the market, they usually expect the volatility to continue. However, after a bulge, the market can often experience a period of consolidation or even a reversal. It's important to look for confirmation from other indicators or wait for volatility to decrease before making trading decisions. That's why we usually take a look at the squeeze as a probable trading opportunity. But bulge, we can use it for closing our trades. Yes, and let's see if you have any other question. Okay, let me just mention one tip about the also misinterpretation of the Bollinger Band squeeze. Some of us might mistakenly assume that the squeeze will always result in significant price movement. However, the squeeze indicates only that volatility is low and a move is likely, not the direction of the move. Okay, so we should combine the squeeze signal with other technical tools such as trend lines, volume analysis, or momentum indicators like RSI and MACD. Depends on the asset we are trading to better predict the direction of the breakout. So it has nothing to do with the direction of the price, just signals the level of the volatility in the market. Okay, very well, excellent. Thank you all for joining us today for this webinar on trading with Bollinger Bands techniques and insights. I hope you found the session informative and that it provided you with valuable tools and strategies to enhance your trading performance. I'm also excited to announce that our next webinar will focus on a couple of trading strategies using Bollinger Bands. Now that we make sure you know all the details about the Bollinger Band components, we will delve deeper into practical applications and specific strategies that can help you make more informed trading decisions. So stay tuned for more webinars and educational content from around it. Thank you once again for your participation. Have a great day and happy trading, guys.